All right. Well, if this thing is working as it's telling me that it is, this is day number 5 of the Insurance Pro Blog Facebook live stream cast thingamajig.
Didn't we establish right before that you got 10 seconds to get going? So they're all gone now. They're all gone now.
Well, that's Brandon Roberts. If you can't
read, Brantley Whitley.
Yeah. Well, I am. So we figured out opposites day. Brandon's showing us his beautiful.
It just occurred to me that we're actually live. I should probably stop doing that.
So stop slurping your coffee now. So before you all run away, we do want to make a little pitch here for our book, Predictable Profits. You can go over to ipblive.com, which you should see in this little thing right here, and read all about it. We would greatly appreciate that, and it would give us some encouragement to keep doing these things. We've grown this audience up to about 8 or 9 people now, which is almost double our podcast audience. So I think we're on to something, Brandon.
We are indeed.
And today we're going to bring you one of the most interesting topics you could possibly imagine talking about life insurance, and that is to talk about ILITs. Irrevocable life insurance trusts. Everybody's favorite subject, right, Brandon?
You are the king of building anticipation.
I do what I can.
And we thank you for it.
Just a little bit better every day. So we're going to talk about ILITs, something we get asked about a lot, something we've talked to clients about a lot. Something when I got into the business 19 years ago was a much hotter topic than it is now. And probably even a little bit hotter of a topic when you got in the business, right, Brandon?
You mean hotter in the sense that there's more people back then who were helped by them?
Well, there certainly were more people that needed ILITs at one time than really you could probably make the argument that need them today. And there were a lot more. I guess what I was thinking about is that there were a lot more agents that were actively selling based on the use of ILITs, than there are now. But we may get into some of that later, but we wanted to share just some of the technicalities with you. So Brandon, take it away.
I get to take it away. I get to talk about all of the really, really obtuse, dense, tricky stuff when it comes to irrevocable life insurance trust.
I'll tee it off with a question. First of all, the 30-second version of why would anybody, what is an ILIT and why would anybody want one? And then we can talk about some of the particulars.
So I think the name Irrevocable Life Insurance Trust basically I thought we agreed that there's no drinking when we do.
There's no drinking from floral coffee, dog. Unless it says the Insurance Pro Blog on it.
Give me a week. So I believe the name is pretty self-explanatory, right? Irrevocable Life Insurance Trust is fairly straightforward. It's a trust that you
we all know what the words mean anyway.
That you can't take back. No take backsies. Yep. So the application of the ILIT is twofold. I think most people talk about one very specific use of it, but I hope that we can shed light on another potential use today of the ILIT. So first and foremost, it's a tool to provide the funds necessary to pay for estate taxes.
Right.
So by virtue of using an ILIT, you take life insurance death benefit and you remove it from the gross estate of the person whose life is insured under the policy. So normally speaking, transfer tax laws say that all assets that you own, including the death benefit of your life insurance policy, is includable in your estate for the purpose of calculating the value of your estate for estate tax. ILITs are used to take that death benefit and take it out of the estate so that it is not included in that calculation.
Right.
So traditionally, ILITs have been presented as a means to have the funds necessary to pay estate taxes when due. Because if you have an estate that is worth tens of millions of dollars and you are subject to the estate tax, there's going to become a tax, or there's going to be a tax bill due upon your death that your heirs are going to have to pay. And they could choose to liquidate the assets that you have to pay the bill, But that oftentimes is tricky. It comes at inopportune times. And so instead, they would like a source of funds that is outside of your estate to pay that bill. And that's what ILITs allow you to do with life insurance.
Right.
The second application, though, of an ILIT is the minimization of your estate through life insurance. So if you have assets that put you near the estate tax threshold and you still want to have life insurance, you could put yourself over the limit with that life insurance. But if instead you own an ILIT or establish an ILIT, you never actually own it, then you could remove the death benefit proceeds from your estate so that it doesn't impact that calculation and subject your assets to estate tax.
Right. Okay. So
we should probably do a rundown on the specifics of ILITs, kind of what they involve and the rules that are associated with them.
Read my mind.
Okay.
It's particularly with the setup, because this is something we have seen, not just in the 6+ years that you and I have been working together, but even longer in our careers. We've seen this fumbled many times.
Yes, we have. So the first step is the individual. We're going to call that individual the grantor because that's what they're typically referred to as.
The legal term, yeah.
Yep. Meets with an attorney who drafts the trust.
Right.
And once the trust is established, the trustee is named, and the trustee works with an insurance agent and life insurance company to purchase life insurance on the grantor.
Right.
Once the life insurance policy is established, the grantor makes a gift to the ILIT for the premium that needs to be paid for the life insurance policy. And at that time, upon the receipt of the gift from the grantor, the trustee alerts the beneficiaries named to the trust that the gift has been made,
right,
and that they have the ability to withdraw the funds from the trust.
Right.
If they choose to do so, they need to notify the trustee, and the trustee will give them the funds. If they don't notify the trustee, then they'll forfeit their right to the funds, and the trustee will do with those funds whatever he or she sees fit, which is pay the premium.
Right.
That is a critical element to an ILIT procedurally, because if that notice to the beneficiaries is not given, and we call that the Crummey notice because it's a reference to legislation that established this feature being a process that removes what we call future interest from the trust or from that gift.
Right.
So that it's not included in the grantor's estate.
Right.
If the trustee does not serve that Crummey notice to the beneficiaries, then the grantor has effectively made what the IRS deems a gift of future interest to the beneficiaries, and the death benefit proceeds can still end up in the grantor's estate when the grantor passes away.
Right. Yep.
The naming of beneficiaries allows the grantor to make gifts to the ILIT up to the gift tax exclusion, without having to recognize a taxable gift to the beneficiaries. So, when it comes to establishing the amount of money that has to be gifted to the trust, that's going to be dictated by whatever the premium is for the life insurance that's being put in place.
Right.
And so, you get roughly you get $15,000 per named beneficiary per grantor. So in some cases, we have situations where there's husband and wife, and they are both grantors to a single ILIT, and they name 2 children as beneficiaries to the ILIT. At that point, they would have a total of $60,000 that they can gift to the ILIT for the purpose of paying premiums.
Because each one can give 15 to each child, et cetera.
Correct.
And that would typically, in that scenario, because I was going to say, look, we should probably give an example, but you just gave one. So in that scenario, in most cases, the way it would have been done in the past, and to some extent still now and into the future, I suppose, would be that the policy in the trust itself would be a second to die or a survivorship policy, as they're commonly known now. Since I came out of the mutual world, everything was always called second to die. But
yes, in that case where you've got husband and wife insured.
Right.
We should note that a lot of the insurance products that sit inside ILITs typically are permanent policies. It's not
right.
It's not unheard of for term insurance to be in an ILIT, but it's not common.
Right.
And the vast majority of ILITs that exist and have existed for several decades most likely have whole life insurance in them.
Right. Most of what I've seen. Yeah.
Because that was the product that existed. Guaranteed universal life insurance became kind of the hot ILIT product as that product came about.
Right.
But the majority of them are whole life insurance products, which means they do accumulate cash value. But it's important to understand that the irrevocable part of this means irrevocable. So the cash value that exists inside a whole life insurance policy inside of an ILIT is, for the most part, untouchable by the grantor.
Right. If I have an ILIT that I set up for the benefit of my children, and I grant the premium to the ILIT pays the premium, the Crummey letters are issued, all the things are done procedurally correct, then that technically means that I, Brantley, do not own the cash in the in the policy.
You don't own the policy.
Because I don't own the policy.
Correct.
The policy, I'm just the insured on the policy, and the trust owns the policy.
There are some limited provisions that can be put on ILITs that would allow the grantor to withdraw funds for the purpose of a spouse or for children.
Right.
That's a topic for another day, I think. But that's just know that it's possible, but it adds a large degree of complexity to.
Right. And this is one of those things that I think people. I mean, I'm glad you brought it up because it's a thing that people need to know, and something we share with people all the time, which is, technically speaking, if you set up an ILIT, you fund you grant money make the gift, I'm trying to say, to the ILIT pays the premium. It's not your money anymore. So, there could be things you could do, but technically speaking, if you want the ILIT to serve in the way that it was designed for the purpose that you set it up for, that you paid the attorney to set the thing up for, all of that stuff, then you need to sort of think of it as not your money. It's kind of like if you own a business, there's a wall between, your
the business's money. It's not your money.
It's not your money.
So it is possible to put a life insurance policy inside an ILIT after the ILIT's been put in place. So you own the policy now. ILIT exists and you put the policy in there.
Mm-hmm.
But you should know that by virtue of doing that, there's two very important considerations. Number one, if it is a whole life policy or universal life insurance policy with cash value in it, the cash that transfers to the ILIT is viewed a gift to the beneficiaries. So if you don't have enough exclusions per beneficiary, you will make a taxable gift to the beneficiaries of the ILIT by virtue of moving the policy in there. And in addition, and this is the big one, there's a look back period. It's 3 years.
Yep.
So if you gift a life insurance policy to an ILIT and you die 2 years later, the death benefit is still included in your gross estate.
Right.
I bring this up for two reasons. There are some people who own life insurance who establish an ILIT after they learn about the estate tax and they decide, why don't I just move this here? It is possible, but there are limits and provisions, strings attached, so to speak.
And if you understand that and make that decision, that's totally fine. People do it all the time.
And in addition, there are people who decide they have an estate tax problem or a need for an ILIT.
Yes.
So they go out and they apply for life insurance. And at the same time, they start the attorney on drafting the ILIT.
Yes.
And then once the policy is ready to be issued, they call up the agent and they go, oh yeah, I forgot to mention, this is going in an ILIT. Is there anything we need to do?
Yes.
Yes. We need to cancel this and start all over again.
We can start all over.
And I mean that. You have to cancel what you just did and start all over again. If you don't do that, then the only other option is to gift the policy to the ILIT.
Right.
And I realize at that point it may not have any cash value, so the gift isn't on the table, but the 3-year look back still is. So it is absolutely true. You have to cancel that policy that was issued. The whole process has to start again with the trustee, not the insured or not the grantor. And the whole underwriting process could be accelerated to some degree, but procedurally the paperwork has to be all done again and again, and there has to basically be a duplicate process in order to follow the rule of the law here.
Exactly. I'm glad you brought that up because I shouldn't say one. That's the most common mistake that I've seen.
Yeah.
Oftentimes the agent doesn't find out that the client's planning to use an ILIT until sometime toward the end of the process.
Mm-hmm.
And it's better. I guess I would say it's better to find out before, but you could save everyone a lot of headache if you just make sure that the steps are done in a particular order.
Yeah.
And I
know there's other stuff that you and I were thinking about talking about today, but this has been our longest live broadcast so far. And I think we should probably put a bow on it here, and we'll come back to ILITs because it's estate planning is a big subject. So this is not the last time we'll be talking about this.
Right. Absolutely. All right. Well, stay tuned. I assume we're going to do another one tomorrow, probably around the same time. And we hope that you will tune us with us then.